Well, Ben Bernanke wrapped up his semi-annual testimony on Capitol Hill. He had 83 questions total from 61 members of the House Financial Services Committee. 7 questions were about Bernanke's actual job, monetary policy. Much of the rest of the time, the Congress people used their 5 minutes for statements rather than questions. I mean, it's an election year. So we can pretty much break down all the worthwhile comments from Bernanke into 4 categories. And we can cover it all pretty quickly here. First of all, Bernanke on QE measures, quantitative easing. He said, if you look back at quantitative easing 2, so-called, in November 2010, concerns at the time were that it would be a highly inflationary environment, it would hurt the dollar, it would not have much effect on growth, etc. But since November 2010, we've had since then the QE2 and the so-called Operation Twist, and we've had about 2.5 million jobs created. We have seen big gains in stock prices. We've seen big improvements in credit markets. The dollar is about flat. Commodity prices, except oil, are not much changed. Inflation is doing well in the sense that we are looking for about a 2% inflation rate this year. At one other point in November 2010, we had some concerns about deflation, and I think we have sort of gotten rid of those and brought ourselves back to a more stable inflation environment as well. So as I'm looking at that testimony, it doesn't seem Bernanke is saying no to QE3. Bernanke, talking about U.S. banks' European exposure, says, our sense is that the direct exposure of U.S. banks to sovereign debt in Europe, particularly that of the weaker countries, is quite limited, is well hedged, that those hedges in turn are pretty good hedges, that the counterparties are diversified, financially strong. If you look at it more broadly, of course, our banks are exposed to European companies and banks inevitably. They are major trading partners and major financial partners, and again, they've been working hard to provide adequate hedges. It's very important to note that if there is a major financial problem in Europe, there will be so many different channels on which that will affect our financial system that I would not want to take too much comfort from that. So, yeah, we're hedged, but it could all fall apart in a heartbeat. Next, Bernanke on potential growth said we have had growth now since mid-2009 and unemployment has come down. But of course, growth is not as strong and the improvement in the unemployment rate is not as quick as obviously we would like. The United States is on an unsustainable fiscal path looking out over the next couple of decades. If we continue along that path, eventually we will face a fiscal and financial crisis that will be very bad for growth and sustainability. The recovery is not yet complete. Unemployment remains high. The rate of growth is modest. So again, you look at the actual testimony, and I'm not hearing not much in the way of green shoots baloney from Bernanke. And I'm not hearing anything really that says he won't take a look at QE3 and possibly go ahead with it. I also didn't see any quotes from Bernanke on the subject of mega banks prop trading in the commodities markets. The big banks are big traders in the commodities markets, and to really control that market, they have built up billions of dollars worth of warehouses and storage tanks. Now, you're maybe wondering what that really has to do with the commodities markets. Well, this allows them the ability to hold commodities in storage, to manipulate the supply side of the equation. For example, if there is a large inventory of oil, the bankers can set aside some oil, set it aside in storage tanks to take that oil off the market and push prices higher. The bankers don't refine the oil. They don't process wheat into flour. They don't roast the coffee beans. They just manipulate the markets. It gives the banks visibility of the market in order to make far more successful proprietary trading decisions. It basically allows the banks to trade with material, non-public information. The banks like the ability to trade on this insider information. And the crazy part is that it is legal. Now, over the next 18 months, the Federal Reserve will have to decide whether to allow the banks to expand their commodity facilities or divest those facilities. Goldman and Morgan Sachs argue the right to own such assets is grandfathered in from their investment banking days, lightly regulated investment banking days, or that at least they should be allowed to retain them as merchant banking investments. I don't know how they came up with that, but, they would keep them segregated from their trading desk, they say. The combination of trading in commodities and also controlling the supplies of the commodities has a kind of nasty history. There was a company that did that with electricity. You remember the story of Enron. Meanwhile, the Justice Department is conducting a criminal probe into whether the world's biggest banks manipulated a global benchmark rate that is at the heart of loans and derivatives, from trillions of dollars of mortgages and bonds to interest rate swaps, the LIBOR rate. The Justice Department is conducting an inquiry into the setting of the London Interbank Offered Rate, LIBOR, or LIBOR. The criminal aspect of the probe, we're not there yet. Several major banks, including Citigroup, HSBC, Royal Bank of Scotland, UBS, have disclosed that they have been approached by authorities investigating how LIBOR is set. Now, we've been following this for a while, and now apparently justice is getting over to the idea of pursuing it on a criminal basis. But so far, no bank or trader has been criminally charged as part of the LIBOR investigation. The investigation has called into question whether firms can be trusted to set a rate that is the basis for about $360 trillion of securities, from floating rate mortgages to commercial loans. By the way, there's apparently no particular regulatory oversight of setting the LIBOR rate. So far, the investigation has discovered that staff responsible for submissions to the London Interbank Offered Rate regularly discussed where to set the measure, with traders sitting right near them, like having lunch, sitting around the cafeteria, right? And they're all talking about, well, where do you want to set the rate? I don't know. Where do you want it? You guys got anything to say about this? And this has been confirmed by traders at 3 firms, that the traders, the interdealer brokers, counterparts at rival banks, all sitting around saying, where do you want to set the rates? The British Bankers Association, the London-based lobby group that publishes the rate, said it has never required banks to erect Chinese walls between those setting the rate and traders making bets on the future direction of the measure, leaving it up to the firms themselves and their regulators. Earlier this week, an EU commissioner said, given the number and value of transactions in interest rate derivatives and the crucial role those products play in the management of risk, any confirmed manipulation of these interest rates would probably imply a very significant cost to the European economy. And that's probably not an accurate assessment, because the reality is that these risk management tools, they haven't been able to manage risk. What they've done is they've worked as tools to allow banks to skim profits without adding value. That's what the prop trading desks are all about. That's what this is all about. The further reality is that these risk management tools are actually at the core of the risk associated with most of the transactions. In other words, they create more risk. The cure is worse than the disease. Eurozone has been dealing with some big issues, mainly the Greek bailout plan that was accepted by the Greeks, or at least by the Greek parliament. And then the ISDA accepted a plan that would apparently not trigger a credit event to have the credit default swaps pay on a default on Greek bond. And so today there was a summit in Brussels, and you're probably thinking it was just a whole lot of fun and waffles and beer and chocolates, but no. Spain announced that it would not meet its deficit reduction targets for this year. They said that they were abandoning the targets. The country is slogging through a worsening recession. Not exactly a startling revelation, but it was rather expected. I think the startling part was that Spain was hoping for some breathing room, and the Germans apparently say no, they want no part of that. We've been telling you that the Eurozone is following the Federal Reserve playbook. Here's a little more proof. After receiving 530 billion euro in free money from the ECB, the long-term refinance operation this week, the Euro banks immediately redeposited 300 billion right back at the ECB. Bailout money goes to the banks, gets hoarded, doesn't make its way into the broader economy. Where have you heard that before? So the Euro crisis isn't over, not by a long shot. I think it was yesterday, Nicolas Sarkozy was just chased into a French pub in Basque Country. Had to hide out there for several hours while the crowd was kind of raging outside. The mood in Europe is foul. Quote of the day comes from U.S. Treasury Secretary Tim Geithner, writing in the Murdoch Street Journal, calling for more regulation of the financial services industry. Specifically, he wants to see the passage of Dodd-Frank. Geithner writes, "My wife occasionally looks up from the newspaper with bewilderment while reading another story about people in the financial world or their lobbyist complaining about Wall Street reform or claiming they didn't need the troubled asset relief program. She reminds me of the panicked calls she answered for me at home late at night or early in the morning in 2008 from the then giants of our financial system. We cannot afford to forget the lessons of the crisis and the damage it caused to millions of Americans. Amnesia is what causes financial crises. These reforms are worth fighting to preserve." Does kind of bring up the question of whether or not those reforms will actually solve anything and whether they can actually get them through. I mean, after all, we're talking here about late 2008. That was nearly, 3.5 years ago now when that started to fall apart. And what has really been done? Have the reforms been put in place? No. They've talked about reforms. They've talked a lot about reforms. They've talked about putting in reforms that would change the speculative trading, but we've seen the price of oil moving higher. Some people think that maybe it's because of the speculative trading that's been going on. What reforms have we seen put in place on the financial industry in this country? Next to nothing. Every step of the way, all the reform has been fought tooth and nail by the financial industry. So far, nothing's been done. 3.5 years down the road. And even worse than that, or just as bad, I suppose, you know that somebody was breaking the law back when these problems took place in 2008. Who went to jail for it? That hasn't happened. And a lot of the laws that related to the subprime mortgage industry, I mean, the statute of limitations is running out. We're looking at a 5-year statute of limitations, and guess what? These things were mainly being written in 2005, 2006, 2007. Yeah, they're finally going to enforce some laws right as the statute of limitations runs out. I guess that's the answer.